First Pacific Advisors is a Los Angeles, California-based investment management firm where we focus on value investing across the firm. The strategy that we run, my team, is the contrarian value strategy, and as part of that, we run the global flexible mandate for Nedgroup. And the goal of that strategy is to achieve equity rates of return over time with less risk in the market, really by avoiding permanent impairments of capital. And the manner in which we execute that is by buying common stocks, preferred stocks, junior debt, senior debt, et cetera, in the portfolio. There's this general view in the world, it seems today, that one can't really do as well or do better than the market over time unless you own the winners. And our argument is that just by avoiding the losers over time, you can do quite well. So if you consider that, looking at just the S&P 500, the U.S. market, for example, over the last decade plus, more than a third of the return of the market would have was the losses that would have been made in the S&P 500 by the bottom 10% performing stocks. So a third of the return, equal to a third of the return, was the bottom 10% performing stocks in the S&P. So by avoiding those companies, one can do reasonably well as a result. So over my time investing in the United States and abroad, just trying to avoid those losers, learning from my mistakes certainly along the way, has helped me to think back to 1998 and 1999, when the world had run amok when it comes to how one values technology companies and internet companies. Prices were taken to wholly irrational, illogical levels. And we looked really stupid for a period of time because we didn't own those companies. So for over the course of 2 years, we were way behind the market. But by sticking to what we do, not chasing these dreams, which they were nothing more than dreams, we stuck to our knitting and did very well in the following 3 years, those subsequent 3 years, 2000, 01, and 02. We made money when the market was down. So we won by not losing, avoiding, we lost some of the, didn't make the gains in 98, 99, but we avoided all the losses in the ensuing 3 years. And then also, as time went on, during the course of the last decade, the omission of ideas, not investing in certain kinds of businesses, worked out quite well. So for example, the financial service industry was taken also to valuations that were way too high, 3 times book value for an American bank, that of dubious credit quality. So poor assets, not great equity supporting those assets. There's an old accounting line that a lot of these banks had. The left side of the balance sheet wasn't right, and the right side didn't have much left. And so by not owning those banks for much of the last decade, one was able to do quite well because the market declined precipitously for these banks following, the subprime, crisis and leading into the great financial recession in the United States. And these banks lost, 3/4 of the value. Some of them, disappeared, as we all know today. So again, winning by not losing. But then to not forget about winning, to not forget about how to go and put capital to work and take advantage of opportunity when it does show up, when the obvious example would be something like the high yield market in 2002, 2001 and 2, or again the high yield market in 2008 and 9. Tremendous opportunities to commit capital and with very, very low chance of losing money. Well, the whole market, the markets around the world have been elevated largely because of low interest rates around the world, easy money. So a lower interest rate raises all equity values. If you just were to present value a stream of cash flows, the equity value is worth more. The more levered the company, the even greater the equity value. And you do double duty there because your equity stub is worth more, but you're also borrowing at a lower and lower rate as rates are dropping. One doesn't have to look much further than the direction of interest rates of the last 35 years to understand why the stock market is where it is. So we look around the globe, but we don't see a lot of absolute value. There's some better relative value. The U.S. is a bit more expensive than other parts of the world. But that said, there isn't any industry group or region that is unusually cheap today. So it's what, by default, leads us to have a certain amount of cash in our portfolio. Cash in the global flexible strategy ends up as a residual of our investment process. If we don't see great risk reward, we don't see the kinds of companies we want to own at the kind of prices that are reasonable, we'll end up in cash by default. Not because we have some large, grandiose macro view that the market gets overpriced. It's simply because we aren't finding the underlying investments that meet our own individual risk reward standards. They're fairly high standards. As I mentioned earlier, not winning by not losing. We avoided financials for much of the last decade, but come 2015, and then into 16, financials were very, very cheap. People were valuing them and looking at them and fighting the last war. So banks were priced, lending banks, the lending institutions rather. There are a lot. We own various financials in our portfolio. It's the largest portion of our portfolio, but some of our portfolio financials are not lenders. They're service companies like Aon. We have a large portion in the lenders, companies like Citigroup or Bank of America and some others. And when you look at these banks in 2015 and into 2016, they were trading down at levels that they hadn't been seen at since the Great Recession, 2008 and 2009 prices. But there was one big difference, and the big difference was that the bank's assets were better, and there was more equity. So look at these banks, the banks that we own, we hold in our portfolio today, these lenders, the average capital ratio they had back in 2007 and 2008 was something on the order of, they were levered 20 to 1. And today it's 12 to 1 leverage. So less leverage and much, much lower valuations. Back then they were trading at 2 and 3 times book value. And a year and a quarter ago now, these banks were trading at 3/4 of book value. So not a lot had to go right in order for us to make money in this position. If I were to think about some of the most important things to, as an investor, the takeaways that I've learned over the last 3 decades of investing is, one, and most important, is to be patient. You have to be patient about doing your work on any given investment opportunity, waiting for that opportunity to present itself, because we can't control price. Price is offered to us. If it's a good price and offers an investment, offers an attractive risk reward, we will look to make that investment. And then waiting patiently for that opportunity to work out. Sometimes it can take an extended period of time. Just because the world offers you something at an inexpensive price, at an attractive risk reward, doesn't mean that just because you've purchased and made that investment, that the next day you wake up, it's going to start going up. It could take a few years. It could take longer. So we've owned a number of hockey sticks in our portfolio for points in time where the stocks are flat for a period, and all of a sudden they go straight up in years 2, 3, 4, 5, 6. And so that operating with that kind of patience is important, as long as you have the conviction and understanding of the work that you've done. And the only way you get that is by having a good team around you, great support around you, as I'm quite fortunate to have at First Pacific Advisors, my partners Brian Selmo and Mark Landecker, and the kind of work that our team does, that deep research we do on the companies that we own. For us, what's I think a little bit different about the contrarian value strategy in our team and managing this global flexible portfolio is that we do have such a broad charter. We can invest in companies of different sizes. We can invest in equities and we can invest in debt. And if we don't find something that's attractive, we can end up in cash. A lot of people will ask us why, do you own why corporate bonds today versus equities, or equities versus cash, et cetera. And for us, we look at equities and debt the same. Whether debt to us, high yield bonds, is the same as an equity. We consider it and think about it as an equity. It drives an equity rate of return for us and for your portfolio. So whether it's equity or debt, we are agnostic. It is what is offering that attractive risk reward. So if we're offered a bond that we're confident can return principal at maturity, and let's say we're offered that bond today and it's a 10% yield, and our expectation for future rates of return are less than 10%, if we can own that bond with that 10% yield, then fantastic. That's going to do your portfolio a good service. But if we're at a point in time, as we are today, where if you look at the high yield market in the United States, where the average yield is about 5.5%, and if you look at the average yield in the EU, where the average yield for high yield bonds is currently 2.6 or 8%, these are not high yields. I mean, these are low yields, and people who are taking that kind of risk to invest in bonds of these companies that offer such low yields for companies that are highly levered, and many of them which are quite cyclical, is senseless to us. So we then just one could argue just go and look at equities instead, because high yield is expensive. But the market's being driven by the same factor, which is low rates. The lower the rates are, the higher the bond price goes. The lower rates are, the higher it takes stock prices. So it's tied to the same thing. If we find the investment that is attractive, whether it be an equity or a bond, we'll buy it. If not, we end up with cash. It's really important for our investors to understand that cash is not a top-down decision. That cash is merely a byproduct of not finding that stock or that bond or the collection, a portfolio of stocks and bonds that offer attractive risk rewards. Our job is to deliver equity rates of return to you over time, over full market cycles. Our goal isn't to beat the market. Our goal is to do as well as the market over time and offer less risk, to afford our clients some comfort, our partners, our shareholders, some comfort that we're managing this portfolio appropriately, in your behalf, as if you've given us all your money. Not that we suggest anybody should, but we do manage the money with that, being mindful of that.